Facebook Live. Oh,
Woo-hoo-hoo! Yes,
this
we
is the
got this.
Merrill and Jennifer Hammond show. We're so excited. We said Merrill Chandler and Jennifer Hammond. Oh, we're so excited. This is so much fun. Finally, we are live on Facebook Live, YouTube Live. We're just on all these different channels. So I want to make sure today, so you need to tune in every Wednesday at noon Eastern time. We're always doing credit myth busting in one form or another. It's credit education. And I say credit for those of you who don't understand fundability, which I do want to start with some basics today and talk about the difference between just your credit score and fundability. But before that, I want to start with one of the most alarming things, because again, we keep getting these incredible things that people come to me and they ask me questions, and not only my real estate clients, but also people who are in the industry. This one is from somebody who's a mortgage lender, which I was just absolutely taken aback by, and tried to do everything I could to not invalidate or make somebody wrong or make somebody, but again, it's
credit shame. Credit shame. We don't want to credit shame.
But I wanted to make sure people know. So he is telling people, so it's okay. Now, in the cycle of a mortgage, it's also one of the big things we always say is don't go buying like your new yacht and your boat and all that stuff when you're in the middle of trying to buy a house, because this is what lenders have said. And this is what this particular lender said to me is, oh, don't worry. You can go ahead and put that $20,000 charge on your credit card because it will not report to the credit bureaus for 30 days. So let's talk about myth busting. Merrill?
All right. First of all, let's understand how the relationship between the parties. First of all, your mortgage company usually does they do one credit pull, a 3-bureau pull when you start the process, kind of find out where you are, right? Just before funding, they do another pull the day before funding to make sure is everything still okay, right? They're going to pull a final report. So what they're looking for is your entire mortgage is based on your debt to income ratio, credit score to determine rates and terms, and your fundability, which are 40 borrower behaviors. 40 borrower behaviors are being measured every time that credit report is pulled. So given that, if you go over and your debt to income ratio is 32% and you go put a $20,000 charge on a credit card, most of the APIs, most of the big lenders, the American Expresses, the Discovers, the Chase City, Bank of America, the top 40 banks are on a system, an API system, which is an automatic data transfer system. I subscribe to myfico.com, which is 31 FICO scores that lenders use. It's the only one legitimate one out there, myfico.com. When you go to myfico.com,
we're not related to myfico because I use myfico as well. There's no relationship, but both of us really love it because it is really good, right?
The truth, the whole truth, and nothing but the truth regarding your credit scores and your fundability. Now, once I get notices within 24 hours of a change in my balance. If I, the consumer on my app, is getting notified of a change in balance, you can rest assured that that is being reported and available inside of the credit bureaus. Those have been updated. Yes, there is a reporting date, but the reporting date is more antiquated compared to because they want real-time balance analysis, right? So the credit bureaus have access to this data. But what happens is that second credit report, worst case scenario, that second credit report that gets pulled just before funding is going to scan your entire profile again and look at current balances. And if you put 20 grand on it and that changes you from 32% debt to income ratio to 37 or 41% temporarily, that's going to create a bump in rate or hey, we can't close because too much data changed and we've got to start over or suspend or delay the process. So just remember that there is a reporting date. It's usually your balance gets reported to the bureaus, usually after the statement close, but there is more intel being transferred to the credit bureaus and measured by FICO then meets the eye. So I don't, again, no credit shaming, but what was true last year and 5 years ago is not true now. So we've got to, and that's why keeping updated on fundability modeling, coming here every single week at noon on Eastern on this channel. We want to make sure that you stay up to date, especially since the credit markets are compressing, shrinking just a little bit. There's a little tighter. Some different products by different top tier banks are changing a little bit. You're going to learn about those here. So let's make sure that you stay tuned and stay tuned in and turned on, because we're going to make sure that you know what time it is in the credit and fundability world.
Exactly. And again, you should know, and I haven't gotten to the point where I have my little banner, but we want to make sure that people can go to getfundablejennifer.com, getfundablejennifer.com, and there's an incredible amount of a wealth of knowledge there. So again, we're going to keep on going through myth busting. Just tons and tons. So make sure you can go there. But the other thing I wanted to make sure, and again, you guys can start posting your questions and stuff in the comments as you're seeing this, especially if you're live right now. Biggest thing though, you just talked about ratios. And so another one that we were talking about, loan ratios. So remember, whether you're doing an FHA loan, there's a different ratio than a conventional, those ratios. But the other big ratio that, again, that reporting question is really important, because if you think it's not going to be reported, you're going out and you're spending $20,000 on new furniture because you're getting a new house. Well, that reporting, we also need to talk about, what about the ratio for what if your limit is $1,000 and you just put $20,000 on your credit? So now you're at like 98% utilization.
Yes. Okay, so let's define our terms. So we call traffic what you charge up and pay down before the due date. We call traffic. Utilization is what gets reported to the bureaus and rats you out to other lenders, who then look at your credit report and your credit score and go, whoa, what happened here? They're carrying a $20,000 balance across the limit, right? So it depends on whether you pay it to zero, we call that traffic, or you carry that balance. Carrying the balance can disturb or change radically what's called the 24-month look-back period. Yes, you heard it here first. The 24-month look-back period is the average usage, the average utilization. Now, if you pay to zero every month and you carry zero, you're looking great, and then all of a sudden you carry a $20,000 balance one time. If you're a lender, all of a sudden, why is this person running for the hills, right? Are they buying furniture, selling it on the secondary market so they can cash out, pack up their bags for the zombie apocalypse? They don't know what's going on out there. They just see your standard behavior over 24 months in increments of 3 months, 6 months, 12 months, and 24. It's just go cruising along. And if you spike, that spike, you guys, is danger zone for the lender underwriting software. Now, if you charge it up, the other thing, so that's utilization. If you carry that balance, here's the other danger. If you have zero balance, you're not using it, you're $1,000, $2,000, $1,000, $2,000, $1,000, $2,000, $20,000, all of a sudden, that software it's like trading software on the New York Stock Exchange. It's like panic mode, right? And it goes into a sell-off. Yeah. The lender software is going to trigger that is not normal behavior. Now, where this gentleman was mostly absolutely correct is that if you charge it up 20,000 and pay it to zero, charge it to 20,000 and pay it to zero, charge it to 20,000 and pay it to zero every month, and you carry no balance, go for it, because that behavior is also accounted for in the software. But if it isn't, then you are in big trouble, and that spike is going to cause you to hit what's called the risk department in that credit card organization, and they may freeze an account, they may lower a limit, It's not common behavior. They might think it's fraud. There's a number of activities that you might trigger there. So what we do in Fundability, getfundablejennifer.com, what we do with Fundability is we show you how the software works so that you can, if you have a big purchase coming up in 2 months, we show you how to increase that so it doesn't trigger and doesn't ruin your day or get your limits lowered or an account shut down because of suspicious behavior. So that's yeah, great. Thank you for bringing that up.
That's an important one. I wanted to make sure that we talked about it. And again, we try to make these 10 to 15 minutes so that we don't get too off, because we can really go. So every week we're going to be doing myth busting. So definitely send in. You can hit us up on social media. And if you want to know more, you can always go to Get Fundable. I got the banner up. Yay! And make sure that you have it. Send us your questions. I want to go on because, again, like we talked a little bit about the ratio for utilization, but also you want to be checking all the boxes. So one of the things I want to talk about next week, there's a couple things. I have a whole long list of them, but one of them is that amazing how to check all the boxes so that you sail through automatic underwriting.
Yeah.
And what does that mean? And I want to define what is automatic underwriting. Why is manual underwriting so bad and hurtful to you, not only for the amount of credit you get, but even your credit, the interest rate, what they're going to give you, how much they love you, all of that stuff. I want to talk about that next week. And even business credit. We have lots of questions about business credit too. How do you get those unsecured lines of credit? How do you check all the boxes for the credits?
Bring it. We're gonna have some fun.
We got lots of them. I have so many. And then of course the fake score. I want these teasers out there. The fake score versus a real score, a FICO score, and what are
FICO scores and FACO scores? It's a thing, and you're not going to believe who is lying to you to your face and doesn't have to tell you legally. Ooh.
Yeah, doesn't have to tell you legally. Now that's a good teaser because we're going to share all that stuff with you. And also the last one I want to put out there as a teaser is you can't repair your way to having amazing credit and fundability.
Correct.
And again, we'll go through some of those definitions, but that's one of the biggest misconceptions I have and the biggest myths out there is that you can somehow just keep repairing your way to a perfect credit score and a perfect fundability profile that gets you through automatic underwriting, right?
Thank you for playing. That is not possible. And a little further teaser, I co-founded Lexington Law Firm, the largest credit repair law firm in the country. And I'm not doing credit repair anymore because of the very things we discovered about fundability.
Yep. So stay tuned. So next week we'll be back and we want to have all your questions. So feel free to hit me up on instant messages or however you want. Again, this is the amazing guru, Merrill Chandler, and you can go to getfundablejennifer.com if you want to know more.
Absolutely. All right. Thanks, guys.
Have a good one.